Good morning. It is Friday, January 30th, 2026. Welcome to the DX Today AI Daily Brief. Today, we are tracking a volatile reaction in the markets as investors scrutinize the massive capital expenditures pouring into artificial intelligence. We also examine the deepening regulatory divide between the United States and the European Union and explore how AI is reshaping sectors from manufacturing to education. Let's begin.
Wall Street sent a sharp message to Redmond yesterday, driving Microsoft shares down 12%, the company's largest single-day drop since 2020. Investors are reacting to slowing cloud growth and expressing deep skepticism regarding the massive capital expenditures required to sustain AI development. Despite these concerns, Microsoft is reportedly considering an additional $60 billion investment in OpenAI to secure its position. Analysts note that the company's heavy reliance on OpenAI creates a significant concentration risk, forcing the market to reevaluate the timeline for return on investment in the generative AI space.
In stark contrast to the sell-off affecting Microsoft, Meta saw its shares rally over 10% in trading yesterday. The market responded favorably to the company's latest AI spending announcements, signaling that investors are not universally opposed to high capital expenditures, but are becoming highly selective. This divergence in stock performance suggests that Wall Street is moving past broad-spectrum AI enthusiasm and is now picking winners based on specific monetization strategies and execution confidence, favoring Meta's current approach over its competitors.
The race for AI dominance is expanding beyond language models into search infrastructure. Reports indicate that Tesla is plotting a $20 billion investment into Elon Musk's xAI initiative. This move is positioned as a direct challenge to established search giants, leveraging the xAI ecosystem as a critical component of future AI evolution. The strategy appears to link this search capability with autonomous vehicle development, identifying self-driving technology as the next major frontier for deploying these advanced intelligence systems at scale.
Discussions are underway for a massive $60 billion joint investment in OpenAI involving Microsoft and NVIDIA. While this underscores OpenAI's continued dominance in the enterprise sector, it is raising red flags regarding systemic risk. By concentrating such vast amounts of capital and development power into a single entity, the industry faces heightened vulnerability. Analysts warn that this degree of centralization creates a too-big-to-fail scenario within the AI infrastructure stack, drawing increased scrutiny from both investors and regulators concerned about ecosystem resilience.
The European Union is launching a new wave of regulatory enforcement that could fundamentally alter global AI business models. Brussels is currently preparing a digital competition playbook to accompany the enforcement of the AI Act. This framework represents a systemic shift, where compliance must be integral to the design process, rather than an afterthought. For global tech companies, this means redesigning compliance frameworks to meet strict EU standards, potentially delaying development timelines as they navigate this new, rigorous regulatory environment.
The Trump administration has formally outlined a policy of aggressive deregulation to secure American leadership in artificial intelligence. Contrasting sharply with the EU's approach, the White House is prioritizing infrastructure development and the removal of regulatory barriers to accelerate innovation. President Trump has declared that this strategy is essential for the United States to win the AI race and dominate global technology exports. This policy shift marks a great divergence in global governance, likely fracturing the international AI ecosystem into competing regulatory regimes.
The era of unchecked AI experimentation in the enterprise appears to be ending. Information officers are reporting a significant shift from exploration to responsibility as CFOs tighten budget criteria for 2026. With many initial projects failing to overcome scalability barriers last year, the focus has moved from simply adding AI assistants to completely redesigning software factories with compliance at the core. The mandate for IT leadership is now clear. Prioritize reliability, quality, and auditability over speed, marking a maturity correction in corporate AI adoption.
Building AI systems that regulators can trust has become the critical priority for the fintech sector. Financial institutions are currently leading the market in compliance-first development, recognizing that the legitimacy of their automated systems depends entirely on regulatory alignment. This sector is setting a precedent for the broader ecosystem, demonstrating that verification of synthetic content and transparent audit trails are no longer optional features, but foundational requirements for any AI deployment in regulated industries.
Consumer-facing AI is finding its footing in e-commerce, where shopping chatbots are poised to transform the customer experience. Retailers are deploying these tools not just for support, but as active sales agents capable of reshaping interaction models. This trend signals a shift toward practical, revenue-generating use cases, moving AI out of back-office infrastructure and directly into the customer journey. It represents one of the clearer paths to return on investment that retailers have found amidst the broader AI hype cycle.
While consumer technology often grabs the headlines, the manufacturing sector is quietly leading the world in actual AI adoption rates. Driven by the need for supply chain optimization and efficiency, manufacturers are outpacing other industries in deployment. This leadership reflects a clarity of purpose. Unlike the speculative returns in other sectors, industrial AI offers measurable efficiency gains. It suggests an ecosystem bifurcation where practical applications with hard ROI are thriving, while more abstract use cases continue to face scrutiny.
Beijing is taking a long-term strategic approach to the AI race by making artificial intelligence courses mandatory in school curriculums. By embedding AI literacy and fundamentals directly into K-12 education, China is actively constructing a massive talent pipeline for the next decade. This moves beyond mere technology investment to human capital development, aiming to secure a sustained advantage in workforce capability that Western nations may find difficult to match without similar systemic interventions.
In response to global developments, American educators and students are increasingly discussing the integration of AI into their own curriculums. However, reports characterize this as largely reactive and exploratory compared to the centralized mandates seen elsewhere. While there is enthusiasm for the technology, uncertainty remains regarding implementation standards. Experts warn that this gap in formalized human capital development could undermine American competitiveness in the long run, even as the U.S. currently maintains a lead in technological innovation. That wraps up our briefing for this week. As the global landscape for artificial intelligence continues to diverge, we will be here to track the signal through the noise. For DX Today, stay curious.